Buddy, this is Kurt Frankenberg with RadioActive Trading, and I'm joined by my good friend Mike Chepka from over at PowerOptions on the East Coast. How's it going there, Mike?
Oh, it's a little rainy and a little wet, but of course, that's not too anything out of the ordinary. But yeah, we're having a good week, it looks like, so far. Of course, I've been busy this week with only 2 days in, of course, due to the fact that we have expiration coming up in a few days here. So a lot of discussion on positions, management, rolling, and so forth, as always.
Yeah, it's darn near payday, which is what we like to call it. Well, we're going to be showing some things that relate to Expiration Friday. We're going to have a couple of Expiration Friday management strategies that we're going to share today. But I think what everybody dialed in for was kind of because right now market conditions are really interesting. We've had the Dow at record highs, and in my email I likened it to walking towards the edge of a cliff blindfolded. You know, let's say an evil genius somehow has set up a situation where every step you take, you make more of a reward, right?
Right.
But as you step, you're stepping toward the edge of a cliff, and guess what? You're blindfolded. So it's tempting. You know, every step you take is like, man, there's more in my pocket. All right, but then again, we're getting closer and closer to that edge. We just don't know where it is. So today I'm going to show how sometimes the radioactive trading income methods can be used in concert. They can be used together. You know, there's 11 different income methods with radioactive trading. We don't share them all, you know, in these free webinars. We only, per year I think we only share like 3 or 4. But out of the 11 income methods, some of them are meant to work together. And we're going to show an income method that locks in a higher gain as your stock goes up, and another income method that takes a gain if your stock goes down, and show how they can be used together in such a way that you capture the movement of the stock going up and down, even though you didn't pick the exact right time to get out. And so that's why I call it calling the market top. Nobody can really predict the future, can they, Mike?
No, if we knew the future, it would already be priced into the market, and there'd be no point to trading, wouldn't it, Kurt?
Right. There'd be no market. But the fact is that we can take a profit as though we had called the market top. That is possible. That is something that can be done. And so today we're going to show exactly how that can be done. Now, folks, I'm just going to ask. Here's how to. First of all, here's how to get most out of this program today. Okay, the most out of today's lesson. We want you to ask questions, and it says please hold questions to the end. I don't want you to hold them to the very end, but maybe hold it for some stops that we'll do along the way. Okay, because it's likely that as we're teaching the lesson, some of the questions that you have will be answered along the way, right? So we'll be able to handle the questions at certain times if they aren't handled by then. Does that make sense? And then the other thing I'd like for you to do is participate in the polls and the prompts. Polls are things like this, where I put up a poll, and I'm just going to put up a poll here talking to the covered call traders, okay? If you're a covered call trader and you've been trading for 24 months or more, can you actually claim the promises that the gurus gave you? For example, 3% a month means that you've had 100% gain over the last 24 months. Or 6% per month means you've had a 300% gain over the last 24 months. Okay? Or are you ahead but less than the above? Or are you about flat? Or did you lose? and you want an explanation about that. Okay, so that's a poll. And, Mike, I put the poll up there just kind of as a test. Today's webinar is not about covered calls trading, but since it's the most popular strategy, I'd like to use that as our starter poll. Okay, so about 5 more seconds. 3, 2, 1, stop. Oh, and the last part there, it ended up being visible by 10. Okay, so out of the folks that are doing covered calls, no one said that, hey, I can liquidate my account for, the compounded stock earnings of 3% a month, which would be 100% gain, or 6% a month, which would be the 300% gain. We do have 3 out of 10 saying, I'm ahead, but less than the above compounded figures, right? Less than the promises that we got from our covered call trading guru. 60% say I'm about flat, so 6 out of 10 are, have worked for the last 2 years to have nothing. And that sounds a little harsh, but that's just the reality. It's what's happened. Okay, and then 10% say, dude, my account is behind. Now, I want to know why. I want to know why my account is behind when I was promised, to make 3 to 6% a month. So, okay. Well, folks, that's our polls. Okay, that's an example of a poll. Here's an example of a prompt. Okay, I'm going to ask you to type in I do. Okay, this isn't a proposal. Okay, I don't want to marry you, but type in I do if you have a stock that is currently priced higher than where you bought in, and you're not sure what to do next. Okay, if you have a stock that's up from where you bought in, okay, we're having a bunch of I do's coming in. We got William. I'm not going to use last names. William says I do. Okay, now you don't have to share it with us. Joseph says I do. Santiago says I do. I do too. You don't have to text it in right now, but if you would like to text in the symbol, we might be able to take a look at it later on. Okay, if you want to text in the symbol, and William already texted in a symbol. William, if you also text in the cost basis, that'd be marvelous. Oh my God, somebody just wrote in, is it true that this company is an affiliate of Compound Stock Earnings? No. No. Have folks that went to Compound Stock Earnings, have they in the past used PowerOptions as a selection tool? Probably, but then again, PowerOptions is a selection tool for a number of individual investors and companies. And there's 23 different strategies that they support, not just covered calls. Okay, John says he's up on CAT, PM, ED. Williams' cost basis on DIS was 54.27. We're going to look at this later on, okay? Richard is up on BAC, Bank of America. Okay, very good. Very good. Jane says they claim that their initial search engine came from you folks.
Let me answer that. Let me answer that real quick.
Go ahead there, Mike.
Okay, yes. Sorry, Jane. Yeah, we did, as Kurt mentioned, have a sort of an affiliation with Compound Stock Earnings in the sense that he sent his seminar attendees to us to use the covered call search tool and, of course, the portfolio tools to track their positions. But he didn't get a commission or anything off of any of the subscribers he sent to us. It was just we were the only tool around that had that. Does his tool come from our tool? In the sense that they sort of tried to
copyright infringement
and create a tool essentially that did just for covered calls, very limited because they were only looking at a certain amount of stocks. They don't technically look across the entire universe of options. So in that sense, Jane, that is how it was developed based on the patented model that Ernie created back in 1997. So that's it.
That should clear things up there. We don't have any affiliation with Compound Stock Earnings or any other company except for RadioActive Trading. And when I say we, I guess I'm RadioActive Trading, and PowerOptions has got an affiliation with me. So, okay, let's see, folks. You're welcome, Jane. Here's what we're going to do. We're going to make a very quick introduction, very quick. And Mike, I'd like to keep this to 60 seconds, okay? Because we want to show some value to everyone. I began trading stocks and options back in the late 90s, and it wasn't to Mr. Hooper's program. It was a different program altogether, but it was similar. And so by trading covered calls, I did actually generate some good income, several months, and then I got hurt. I got hurt really badly, and found out that if I had done things just a little bit differently, I wouldn't have gotten cleaned out of my life savings like I had. I would have actually made a profit, and even if I was long on the stock.
Mm-hmm.
And so I began tinkering with that for the next 2 years, and then I began trading the strategy for real with real money after that and blogging about it, and ended up having some folks say, hey, man, have you written a book? Because if you have, I want it. And I said, well, I'll write it if you'll buy it. And I actually accepted a lot of pre-publication, which I call it reservations, pre-publication reservations, where the whole project was paid for before we even started.
Mm-hmm.
And pretty cool. That's my story. And back in 2002, that's when I wrote the blueprint. Since then, back then it had only 4 income methods. That's all I knew back then. But since then, we've added 7 more income methods and sold the blueprint in 38 countries. So, Mike, real quick, how did we meet? And let's show folks how that all comes together and it's going to affect them.
Okay, yes. Well, Kurt and I met. Kurt was actually a customer of PowerOptions. I'm the Director of Education here at PowerOptions. I've had the pleasure of working with Ernie and the PowerOptions staff for the past 10 years. Kurt was actually a subscriber, and he called up for a coaching session. He wanted to know how to use the historical tools to identify the types of trades that we're going to take a look at in a little bit. And so, excuse me, during the session, I saw what Kurt was doing, and I said, well, I can appreciate that you're limiting risk, but at the same time, kind of concerned how you're going to make any profit. I don't see how you're going to make profit unless the stock moves up 20, 25% or so. Well, Kurt said, why don't you join me for my free presentation, just as all of you are doing now, and I'll show you exactly how I make money with these techniques. Of course, that was about 5 years ago now. I was so impressed with the presentation that I invited Ernie to join me for the next 2. Ernie, of course, had been trading for about 20 years before he created PowerOptions in '97. And Ernie was so impressed with the technique that we decided to partner up with Kurt and enhance the married put techniques, married put pages, I should say, on the search and, of course, for the portfolio tools to work specifically for radioactive trading, as well as the other 23 different strategies. But the married put techniques, the married put searches, and the when you're tracking a married put in the PowerOptions portfolio, it shows you examples and ideas of implementing the radioactive trading techniques.
Yeah, something I really appreciate about PowerOptions is that they followed every single one of my suggestions when it came to how to set up the search for married puts, but also how to implement the income methods and see how the chart would look before and after one of the income methods. And then they've also accepted all the feedback from all the radioactive traders that have become a community and have really enhanced that section of the PowerOptions site. So it's pretty exciting. Mike, I've got a poll up there, and I want to call everybody's attention to it. I'd just like to know what kind of strategies you're trading right now. And let me go ahead and close that because we've had it up for a bit and share the results. The majority of folks online are doing spread trades, but second place is cover calls. And of course, since you can do more than one strategy, right? This poll here adds up to more than 100%. Folks, I think you're going to be really pleased, especially the spread traders, because we're going to show you how to do a spread trade risklessly, and that's kind of exciting. Also, folks that are doing cover calls, if that's all you do, you're going to see that it's possible to do more than just that one-trick pony and have better results. So I'm going to go ahead and hide that. We've already asked what kind of options plays our audience is doing right now. I'm going to ask you folks, how happy are you with that so far? Okay, are you happy? Yes, no, or somewhere in between? I'm making 3 bold promises in this webinar, okay? And I'm just going to go ahead and speak without the slides. I'm just going to speak while that poll is filling in. I'm going to make 3 bold promises, okay? Number 1, I'm going to show you the solution to a big problem that's facing buy and holders today. Okay, folks that are marching towards that cliff, like what we talked about, you know, every step you take gets you a little bit more, but every step you take also brings you closer to the edge, right? Well, I'm going to show you the solution to that problem. That's bold promise number 1. Okay. Bold promise number 2. I'm going to show a riskless spread trade that's done at a credit. All right. Normally, a credit spread involves risk, but remember, I said that this would be riskless, and it is riskless of itself. Okay. It's possible to take income from your stock without necessarily selling it or limiting your upside potential.
Right.
And then finally, number 3, I'm going to show you how to ratchet up your exit point, not with a trailing stop-loss order like most trading systems might encourage you to use. Mike, is a trailing stop-loss order a definite way to close out of a position at a profit?
Not necessarily, no. There can still be a gap which would cause the position to get filled, but not filled at the price that you were hoping at. Or hoping for, I should say.
If there's a big move like like the flash crash of May 6, 2010, or just a precipitous plunge like we had in March 10, 2000. Oh my God. Your stop-loss orders are not going to protect you. In fact, they may end up hurting you. Okay, but I'm going to show how to ratchet up your exit point, kind of like a trailing stop-loss order should, but with something real that guarantees a better exit. Okay, and that's this one's your favorite, isn't it? That's income method number 4.
Well, it's one I use the most. It's just, and I've been writing about it, but we'll talk about it when we get there. A lot of the times what I've noticed recently, Kurt, just based on where volatility is that using income method number 4 actually lowers the risk more than the income method number 1 opportunity. We'll probably be able to see an example of that as well.
Yes. Mike, I have already done these polls. Okay, what kind of option trading are you currently doing? We've got about 3 out of 4 folks in the room doing spread trades, and about 6 out of 10 doing cover calls. And when I said, how happy are you with your trading results, this is what I got. Okay? Nobody said, I'm very happy. 55% said, I'm making money. Not enough, but I'm making money. 27% say mixed emotions. I see potential, but I really need to change my game in order to, have better results. 18% are ready to quit just to stop the hammer chain. They're losing so badly. They're thinking, man, maybe this just isn't for me. So, Mike, later on we'll do a poll where we'll show the techniques, okay, and then after that poll we're going to revisit this question and see if it would have been an improvement. Okay, so here's the problem. The problem is I don't know the future. Neither do you. Okay, no matter what we've been sold. Like I bought into that. I got that black box trading system. Well, I'll go ahead and say the name of it. Wise Trade. I got into Wise Trade about 13 years ago, where it has all these green and red lights. The green lights mean okay, it's time to buy, and the red lights mean it's time to sell. And that thing cost me more money than it cost me, if you take my meaning. The piece of software was about $4,000, and I lost more than the piece of software cost me. Okay, so I don't know the future. Neither do you. We just don't know. Okay, so let's look at this stock here, Mike. The far right edge. This is today. Well, it's not really today. This was about a year ago. Okay, but if it were March 26th today, okay. This is the far right edge. We don't know what lies beyond that far right edge. But looking at this, would you say that it's bullish or bearish or sideways-ish? What would you think?
I don't know.
Yeah, you don't know. Hey, honest answer. You can always be correct. You can always give a good answer if you don't know by saying, I don't know. So, and that's great. Okay. So now what? We've got RCI. We're holding on to RCI, and we just don't know where the top is going to be. Okay. Now, I wrote a haiku about this. Okay. You don't want to feel like a chump. If I sell my stock and it keeps going higher, I will miss the boat. Okay. That's my first haiku. If I sell my stock and it keeps going higher, I'll miss the boat. You're going to feel silly because, geez, you got out and it kept going and going and going. I think that in the 80s when people were looking at MSFT, Microsoft, several times along the way, people said, nah, I can't see it ever getting any higher. I'm going to get out now. And that would have been a mistake. right? Because it kept going higher and higher.
That's right.
Yeah. On the other hand, maybe right now is the peak. Maybe right now is the best time to get out. If I hold it, I might give back my profits. You might even see something that turns into a winner, turn around and become a loser to you. Mike, I've had that experience. Have you?
Oh, absolutely, Kurt.
Yeah, and I think some other folks on the line may have too. I don't have that experience anymore, but I had. I did. All right, so there's another haiku. Okay? Now, here's how we can solve this, all right? And we actually had a client write in the thing that inspired this lesson was we actually had a radioactive trading client write in and say, hey, I work for this company, and so I've got this stock at a low cost basis as part of the compensation plan. It's at $27.50 cost basis, and I own, X amount of shares. And he had it at, a low cost basis, and he wanted to know what he could do to bulletproof it without getting hurt, okay, or without spending anything. Now, here's the deal. We told him exactly which put option would be a good idea to get. We also told him about the income methods, all right? And if he had done this, I don't know if he actually did or not because I don't have personal contact with every single, situation before and after. But here is exactly where RCI peaked, and then it began a serious plunge. Do you see that, Mike? How it's dropping off, like, seriously. Even gapping. See this gap here? Whew. All right. Anyway, here's the deal. Why hasn't the problem been solved yet? Why is it that we haven't been able to solve, should I sell or should I hold? Well, the reason is that we've only considered those two choices. We've only considered, well, should I hold or should I sell? Okay? We've only looked at, for example, maybe fundamental analysis. Fundamental analysis tends to value a stock. And so we say that, hey, here's the target value. This is what we think it's really worth. And when the market wises up and finds out that it's really worth this, that's when to get out, okay? It'll go up to this price and then get out at that price, okay? Or technical analysis, you see the chart do a certain thing and you say, oh, you know what? It's peaking. It's peaking. We have to get out right now because tomorrow it's going to go down, all right? Well, only two choices, hold and sell. Only two methods, fundamental and technical analysis. Well, I'm here to tell you that there's another option, and yes, I am trying to do a play on words there, if you want to cut your losers short and let your winners run. So here it is. We're going to show how to structure the radioactive profit machine first, okay? Now, March 26, 2012, that's the chart that we were looking at. The shares of RCI were trading at $38.95. Now remember, our radioactive trading client, Robbie, had shares at a $27.50 cost basis. So what we showed him would have bulletproofed him without any cost. All right? But most of us don't have that luxury. Okay? He wanted to know how to bulletproof his stock without spending anything, and we're going to try and call the market top. We're going to consider, geez, this is cool if the stock is up from where we bought it. Okay? It's not as cool, but it's still cool if we get the stock that day. Okay? If we get the stock that day, because many of us don't have the advantage of owning a stock that's way up, although William does. Right? Let me see here. John does. Oh my gosh, we got a pile of these guys. Let's see here. Richard does. William does. John does. Joseph does. Kathleen does. Okay, we got a whole pile of them. We would like to know. What your cost basis is. Okay, so John has written in CAT at 54, ED at 48, PM at 44. Mike, while I'm doing this portion of the presentation, could you maybe look at which of those might be a real good example?
Yeah, I've already wrote down 6, Kurt. from
Oh, you're
earlier
so
answers. So yeah, we won't have time. We'll probably only have time to do one of these examples actually. So we'll see.
That's fine. That's fine. We're going to demonstrate how to buy the stock and set up an insurance policy. An insurance policy we won't be spending a dime on. So that's pretty intriguing. Let's check it out. Okay, so March 26, 2012. Okay, Robbie had these shares at a cost basis of $27.50, so he was in a better place. But we're just going to consider, hey, what if we just got in right now? What if we just got in right now and bought a put option that's a few months out in time? In this case, it's 4 months out. Okay. Generally speaking, I go 5 or more, but for the sake of this example, you know, and the parameters that Robbie gave us, he didn't want to get hurt. Okay. Here's the deal: we're spending $290 on the put, so our total invested amount is $41.85. Okay. Our guaranteed exit is $40. How come?
Well, because when you purchase the put option, that gives us the right. We now own the right to sell our shares of stock at that price at any time. We've purchased the right instead of selling something that puts us into an obligation.
Right. We don't have to sell this at 40. Okay. But if the stock goes down, we have the put option that protects us at 40. Okay. So essentially, when we've made this investment, one fellow just wrote in and says, in the money puts? Why would you do that? Well, it's backwards from what you might expect.
But there's a reason
why.
The
thing. Yeah, there's a reason why. I'm guaranteed to get some of that put back. Okay, so the total amount at risk here is $1.85 if I'm buying RCI at $38.95. Now, if I was buying RCI, if I had RCI at $27.50, would I have any risk at all?
No, not at all.
No, because the cost basis of the stock and the put is lower than the, you know, the exit price of the position. Okay, all right. So here's the deal. I've got 4.4% risk. All right, $1.85 of the $41.85 invested. All right. Now, I know I said something. I said we were not going to pay for that insurance policy. Right? Didn't you say you weren't going to spend anything? Well, yeah, I did. And that's where the income methods come in. Now, there's 11 different income methods. Recently, I helped a lawyer, an attorney named Steve. He had 1,600 shares of Starbucks at a low cost basis. I showed him how to get paid to have an insurance policy on Starbucks. And guess what? When Starbucks went down, his insurance policy kicked in, but it had been paid for. Really interesting. He ended up using the proceeds of his insurance policy to buy another 100 shares of Starbucks at a zero cost basis. Really cool. Well, instead of talking about it, let me show it to you, okay? Didn't you say you weren't going to spend anything? Right, I did. I said we're not going to spend anything, and yet we just spent $2.90 for the put option. Here's what we're going to do. We're going to finance the cost of it by selling a bear call spread. Now, 7 out of 10 of our members today know what a bear call spread is, at least, because when we did the poll, we found out that that's how many folks were already doing verticals. Okay, how many folks are doing it? Okay, so Mike, if I sell the April $35 call for $3.60, buy the April $40 call for 30 cents, I'm going to make a credit of $3.30, right?
That's right, Kurt.
Okay, but there's a problem with that. What's the problem?
Well, in this case, you know, in general, I wouldn't open a spread in this fashion. It's too close to at the money, so it doesn't have a high probability. But the risk here is if you've got a 5-point spread and you sell it for $3.30, if the stock moves up, maybe as you're expecting, you could still lose $1.70. You'd give that $3.30 back, then lose $1.70 as well. Exactly.
Now, here's the deal, okay? We're going to do this in the context of already owning the stock, okay? Because the objection is, doesn't that put even more at risk? You know, you've got your $1.85. What was it? $1.85 at risk in the bear call spread. I'm sorry, in the married put. Let's go back. I want to make sure. I can't do it by memory here. Okay, there it is. $1.85 is what was at risk with the married put, and $1.70 is what's at risk with this bear call spread, right?
Mm-hmm.
So does that add those two risks together?
Well, we would think so, but that's not technically what happens, is it, Kurt?
Right. That's not what happens. It's not how it works. Okay. That 330 credit comes with a $5 liability, yes. I mean, if the stock goes up, I'm going to have to pay back $5. So I've taken 330, and I'm going to have to pay back $5. But wait a minute. That's just to close the bear call spread. I also own a stock that'll be up.
Mm-hmm.
I own a stock that'll be up. And because of the context, because I own the stock, and the stock going up costs me the $1.70, that stock going up is going to help me. Okay? Kind of cool. In Robbie's case, this is what his, what do you call it, his risk-reward picture looks like. Mike, what's missing from this picture?
Well, there's no break-even line, and there's no red. There's no chance for loss on this position now.
Right. There's no break-even line. If the stock goes down, the lowest point right here, he's making a $972 profit or 35.9% profit. If the stock goes to 40 and hovers there for 4 months, if it goes to 40 and hovers there for 4 months, that's the worst thing that could happen. Now, if the stock goes down, here's the present price. This is the green. If the stock goes down, right, and it's less than its present price of what is it, $38.95? If it ends up less than its price of $38.95, we're going to make a profit, both on the put and on the bear call spread.
Mm-hmm.
And if the stock goes up, we're going to manage our bear call spread, but the stock going up is going to not, it's not going to get capped. You know, if we sold a covered call and that's all we did, would we cap our upside?
Absolutely.
Yeah. Okay. Now Jane says I entirely missed that. Is it possible to explain it again? Yes. We're going to be going through this.
You can just outline the legs here. There's 100 shares of RCI at $27.50. That was the cost basis for Robbie. Remember, the stock's up at $38.50, $38.84. So there's an unrealized 11-point gain. Now, to protect the shares,
just the put.
bought a July 40 put for $2.90. Now, this was about 5 months out in time. There's a reason why we do this, to take advantage of sort of the 3 core principles of radioactive trading. We might explain that in a little bit. But we're bought a July 40 put, so that gives us the protection on the downside and leaves the upside open. But to help pay for that put option, an April 35 call was sold. So it's a shorter term expiration. But if you just sold that April 35 call, Kurt, what would have happened?
Well, we'd cap our upside. We'd in fact hurt our prospects as the stock goes up. We obligate ourselves to deliver it, and then our put option starts going down. We could actually lose money by doing that.
That's right.
That would be a bad thing. But in the case of using a very small portion of our 360 credit to buy another call, look at this. It's going up. No, Jane, it's not a misprint. This is what comes of 11 years of tweaking the radioactive trading profit machine. We call this this married put setup, where you buy an in-the-money put that's far out in time. We call that a radioactive profit machine. And after tweaking this for more than a decade, we found ways to pay for our insurance policy. It's very cool. Okay. All right. So, Mike, this is if we use Robbie's cost basis. Well, let's say we just buy the stock, and we don't have Robbie's advantage of getting in at $27.50. Let's say that we got in at $38.95. Okay. We're going to go ahead and show our chart again, but it's going to be a little different. Oh, by the way, the reason that bear call spread cannot hurt us is that if we're called on to deliver the stock, we already own the stock, right?
That's right.
I mean, what's risky about a bear call spread? It's because if the stock goes up, you've got to use your upper strike call to lock in a price so that you can deliver at a lower strike, and that's going to cost you money, right? But if you have the stock in hand, it doesn't cost you money. That's why this bear call spread is riskless. If we're called on to deliver the stock, man, we own the stock. How about that? So rather than having to buy the stock on the open market or use our upper strike call, okay, we just turn it over. We've got it, okay? So the $2.90 for the put option is financed by using the 330 credit from selling a bear call spread. So, Mike, we actually have taken a credit here to get an insurance policy. Isn't there more commissions that way, Gene asks. Yeah. Dude, at stock trade, you pay $7 for that transaction. At Options Express, you pay $9.95.
But let's look at another way here.
Yeah, go ahead.
I always like to look at it this way. Now, Gene, I appreciate what you said there, of course. It looks like it's an extra commission. Hey, you bought a put, you had to pay a commission, and then you're entering the spread, you've got to pay a commission. Commissions are really the price of business. But let's look at it the other way. Let's say you wanted to minimize commissions, and when the stock was at, what was it, Kurt, $38.95, you had a cost basis of $27.50. Let's say that you sold an April 35 call, as we showed. You just did a covered call and you did it at a buy right. Or you opened the stock at 38 and you sold the 40 call and did just a buy right and paid one commission. Okay, so if the stock went up, you might make your 2 or 3%. The stock's currently at 49, so most likely you would have bought to close that call, rolled up to a 45, then bought to close that call and rolled up to a 50. You're paying more, of course, to buy back the call as the stock moves up, so you're actually not gaining much by rolling this covered call position, but now you've just paid one extra commission than what we just showed because you had to continuously roll the call to get higher appreciation. So
yeah,
by chasing
that stock, you're actually going to incur more transaction costs.
That's right. So that's the key. I mean, we look at any strategies. I hate to say it, but it's the cost of doing business, and regardless. And if you wanted to have a stock that was moving up and you expected it to move up and you're doing just a covered call, where you're going to try to keep rolling that call, and you're going to pay a commission each time you do that as well. Go ahead, Kurt.
All right. Now, Mike, what we're going to do is show this calling the top phenomenon, okay? And it's not that we're going to be able to accurately predict the future. But what we are going to do is we're going to capture the movement. And that's what we want to do anyway. Mm-hmm. We want to capture the movement as though we had perfect knowledge of what was going to happen in the future. Okay? So, Mike, if we had done the bear call spread as I showed, when the stock was at $38.95, okay, and it was a $35 slash $40 bear call spread. Here's what happens on expiration Friday. The stock is at $39.66. Okay, so am I going to, as far as the bear call spread is concerned, is that going to cost me something?
Oh, yeah. If you wanted to adjust now, you're going to have to pay a little bit to close out your obligation.
Okay. Well, here's the deal. I'm going to either buy to close the bear call spread, or I'm going to allow it to be assigned and then buy the stock back, okay? Either way, I'm going to be spending money to unwind that $3.30 credit that I got. Now I've got a liability of about $4.66. You see that?
Mm-hmm.
Hello?
Yeah, I'm sorry.
All right. But here's the thing. I've taken one credit of $3.30, okay? And now I've spent $4.66. But look, I can roll that bear call spread into the next month, okay? And even, you could definitely get in the spread here, Mike, but even with the natural bid being as much as you'll get here and the natural ask being as much as you'll spend here, even so, that's another $3.50 credit, right?
Mm-hmm.
Okay, so I've taken in a $3.30 credit, had to pay more than $3.30 back, and then I took another $3.50 credit. How about that? Okay, one thing a lot of folks don't get is that you can often roll a bear call spread at a credit. And even if a credit's not taken, in this case it was not taken, even if the credit is not taken, it can be advantageous to close one bear call spread and open another, okay, to roll it. Rolling the spread delays your delivery of the stock. And if we had delivered the stock, Mike, we would have still, we would have profited, right?
That's exactly right, Kurt. Mm-hmm.
Yeah, but instead we decided, you know what, let's hang on to it and see if we can do even better. Meanwhile, the stock going up or down in this context guarantees a gain. Okay, for Ravi it did. Okay, on May 18th, expiration Friday, RCI had gone down to $35.21. Okay, if we want to hold on to our stock further, it would cost us 21 cents or thereabouts, right?
Mm-hmm.
Okay, so here's the analysis. Okay, we did an April call spread for 330. We did a May call spread for 350, and so the total income that we've taken is $6.80. We're treating this just like we treat a small business. Okay, Mike, I own a martial arts studio. I've owned a martial arts studio for 27 years, and something that I always do is I try and stay on top of this. Money taken in, money's paid out. Okay, that's what you got to do as a business owner. Okay, now we've paid for the July $40 put option, right?
Yes.
And we also had to manage the bear call spread in April and manage the bear call spread in May in order to keep our stock. So we've taken in a total of $680 and we spent a total of $777. So that's a net expenditure of 97 cents, right?
Mm-hmm.
Okay. Now, I want you to think about this, okay? We used our put option. We used income method number 6 to pay for our put option, and we've done some management. It's like we've spent 97 cents. We've added 97 cents to our cost basis of our stock. Okay? Now, here's the deal. Ravi was in a better place than we were. Ravi had stock at $27.50, but we had to buy the stock at the price that it was trading at, right?
Mm-hmm.
When we add 97 cents to our cost basis of the stock, we get $39.92 cost basis for our stock and our put option, which is still in effect. Remember, we buy the put option far out in time. It's out to July.
That's right.
And by May, this is our net position. We've paid 97 cents net for and added to the cost basis of this stock. So now our total invested is $39.92. Do you remember that July put is a $40 put option?
That's right. Mm-hmm.
Okay, so what's my risk now?
Well, now your new at risk is only about 8 cents, isn't it? Well, it's negative 8 cents. I apologize. So you're
Negative
still
8 cents.
bulletproof. Yeah. And you still have
I should have put a minus sign there.
Sure. But we still have the positive upside. So we're guaranteed 8 cents now, even if the stock collapsed. But we still have the unlimited upside profit potential.
Now let's say that we're Ravi. Okay, we're Ravi. The stock is priced at $35.21. Ravi got in for $27.50, but you know what? He doesn't have to get out at $35.21.
Mm-hmm.
He can get out at $40. Is he happy?
Yeah. I think so.
How about you and me? You and me, we got in at $38.95, and dang it, our stock is down to $35.21. We have a loss on our hands. Oh, wait, because we did the income methods and the radioactive trading profit machine, we're actually guaranteed a profit, and there's still time left.
Mm-hmm.
Okay, better situation? All right, I'm going to ask folks, hey, look, think about what I just showed you. Okay, think about what I just showed you. If you limit risk down to say less than 6%, we limited our risk on this trade to 4.4%, and then we took a credit using the.
That's right. Yeah, every position's opened with. We showed the example, Kurt, with Ravi of having a gain in the stock. We may take a look at other issues as well today. But if we just open that position from scratch, you showed. We open every position in that fashion. We're looking for a risk between maybe 4 to 8%. But then we have those 11 different arrows in our quiver there to help lower that at risk. But go ahead with your poll now. I just want to make that clear.
Yeah, if you limit risk, for example, if you just think back over the last 12 months, if you took no loss that was greater than 6%, but you still left your upside open, took no loss that was greater than 6%, but you still left your upside open, would you have had a better year? All right, that poll is filling up. Let me give it another 5 seconds. Okay, 3, 2, 1. Okay, 12% say I lost overall last year, but I would have won if I'd have done that. If I'd have just limited all my losses down to 6% or less, like you showed, that would have done the trick. Okay, and a lot of times, Mike, we don't consider this, but the fact is if our losses are lower, then we have more in hand to put into the winning trades. How about that?
That's right. We keep more of our marbles, both financially and mentally.
Mentally, keep your marbles. 47% say, you know what, I might have still lost, but if I did, I'd lose much less. And another 47% said, I would have been one that said, I'm very happy with my trading. And today we didn't have anybody say that. Nobody said, I'm very happy with my trading. We had, I'm making money, but not enough, right? Let's look here. Are you happy with your 12-month performance? 55% said, making money, but not enough. Nobody said, I'm very happy. Nobody said, I'm absolutely kicking butt and taking names. Okay? And so would this make a difference? I think so. You know, an 8-cent profit maybe isn't something to write home about, but it's not shabby either when the stock's at 35.21. And Mike, a lot of people on the line are in Ravi's shoes. A lot of people on the line have stock that's up from where they bought in. If Ravi made the decision to sell right here, he would have only taken $38.95. But in fact, he's guaranteed 40 because of what he's done, right? If, you know, that's kind of cool, especially when the stock is down to 35.21. when all you could sell the stock for by itself is 35.21, when the fact is you're guaranteed 40 back, that's a better place to be, okay? All right, now for the secret sauce. We're going to add something even better. Oh, first we'll just take a look again at the before-after. Before, if it was you and me, Mike, buying the stock at $38.95, if it goes down to $35.21 like it did, that would be a $3.74 loss. But in fact, we would make, you know, an 8-cent profit. Not a lot, but it beats the tar out of, you know, taking about a 10% loss. Okay, so I'll take door number 2. All right. Now for the secret sauce, because we only showed income method number 6, right?
And
we've only shown one income method so far. During this time, we might have also done another during this period of time that we showed there. Income method number 4.
Well, hold on a second, Kurt. Before we jump into that, I just wanted to make a comment here. We had someone come in and say, hey, I'm a little lost here. Well, what we are sharing is a different way to look at investing that solves the problems of covered calls, leveraged investing using long calls and long puts, and spread trading, which get investors into trouble. Now, the examples that we showed, the first one was using a unique form of the Mary put or protective put position on a stock that had gained. But then we also can use this to open a brand new position where we keep our risk limited to single-digit percents, the 5 or 6% that we just asked about in the last poll. And then we use these 11 different income methods to lower that initial at risk. We start off with 5%, do an income method, we lower risk to 2%. We still have 6 or 7 months maybe of protection in place with the far out put option. So eventually we can bulletproof the position, so meaning we have no loss on the downside and still have unlimited upside. Now what Kurt's going to share now is a different adjustment. He already showed income method number 6, one of the 11 different ways that you can use to lower the risk on a Mary put, and now we're going to show the income method number 4. Okay, Kurt, so that was just touchstone, and now we can go.
Very good. Okay. Now, here's the deal. During the period of time that we showed, RCI hit a high of $40.58. Actually, it touched that level twice, okay? It touched it on April 2nd, and then it touched it again on, I think it was April 17th. It went to $40.58. Now, here's the deal. One of our income methods, income method number 4, is based on manipulating the put option, not selling calls, okay, or selling bare call spreads to get a credit. What we do here is we adjust the put option. Now, here's the deal. When RCI went above 40, that's when it's attractive to do income method number 4. For reasons I'm not going to get into right now, it's just the time to do an income method 4 play, okay? So here's the deal. at that point, we would sell to close our July $40 put for $1.70. Now, I know we spent $2.90 for it, right? And this looks like a loss. It does. But remember, in order for our put to be down, our stock has to go up.
Right.
And we own both. All right. So here's the deal. Our put option is now 100% time value. You see that?
Yes. Mm-hmm.
Yeah. The stock's at 40.58 and it's a $40 put. So it's now 100% time value. We're going to use the time value in that to buy a $45 put option, which is part time value, but also part intrinsic value. And that's one of the principles of RadioActive trading is we're using time value, we're selling time value to buy intrinsic value. Now, because of the July $45 put option was $5.40, this is not a credit, is it? It's
No, we're paying a debit to make this adjustment. So why would I want to pay $3.70, Kurt, more into a position that's moving up in price?
Well, because it guarantees you, if the stock turns around right now, you're guaranteed a higher payout.
Mm-hmm.
Okay? You're spending $3.70, yes, but you're buying a $5 higher insurance policy. $3.70 for $5 guaranteed is a good trade. Okay? And this is something that wasn't obvious to me 13 years ago, but it is now. It's something that that we use to ratchet up our payout. Now, I know what folks are thinking. They're saying, hey, you want to add $3.70 to the cost basis? How is that a benefit?
Mm-hmm.
Well, it's not like rolling a covered call, although some folks will spend money to roll a covered call, won't they?
Of course we will. Mm-hmm.
Yeah, well, this is a better plan. Here's the deal. Let's think about it, okay? Remember, the price had been $38.95, okay? And by using our put option and our income method 6, we added 97 cents to the cost basis, right?
Mm-hmm.
Okay, so that gives us $39.92, and we're guaranteed to get 40 of it back, okay? So that makes our guaranteed return 8 cents. But if during this time we also did income method number 4, okay, we would add in $3.70. Okay, here we are, $38.95,
Mm-hmm.
97 cost basis. Okay, total invested is $39.92, and then now income method number 4 adds $3.70 to the cost basis, right?
That's right, Kurt.
So now our cost basis is higher. It's $43.62. Well, so what? Well, I'll tell you so what. That new put option is a $45 put option. So instead of being guaranteed 8 cents back, we're guaranteed $1.38 back.
Mm-hmm.
Was that cool?
Yeah.
Especially since we can continue to ratchet this up and up and up. You know, Mike, buying the July 45 and selling the July 40, that's a spread trade, isn't it?
Mm-hmm. Well, yeah, if I open them both at the same time, sure.
If you open them both at the same time, it's a spread trade. The fact is we already own the July 40th.
Mm-hmm.
Okay, we already own the July 40 put, but we sold it and simultaneously bought another one. So it's like a spread trade, but there's no risk. There's no risk. If the stock continues to go up, well, we've locked in a $1.38, and we can go up even higher.
Mm-hmm.
And if the stock goes down, well, we get our $1.38 out of the deal, okay? And there's still time left to expiration, so that stock could continue to climb. All right, so, Mike, I'm going to ask everybody, what do you think of spread trades that don't risk anything? What do you think of a spread trade that you do after the fact? For example, income method number 4 is a spread trade that you do after the market's made a move. Instead of anticipating what the market may do and biting your fingernails down to the second knuckle, right? We do that spread trade after the market's made a move and lock in a higher return.
Mm-hmm.
That's cool. And income method number 6, the way that we did it, didn't pose a capital risk at all.
Now, Kurt, can I steal the screen from you after we do this poll real quick?
Do you want to show?
I want to show another.
This with one of our.
I'm going to show another example of income method number 4.
Oh, okay, good.
But I want to show it and then compare it to what I had mentioned earlier about income method number 1.
Okay, we've got time for that because we're actually slightly ahead of schedule. And that's kind of cool. Mike, I'm sharing the results here. What do you think of spread trades that take income, risk nothing that if they go against, and still leave the upside open? 56% say that beats the shiitake mushrooms out of cover calls, and it does. 25% want to know, can I do that in my IRA? Yes, everything I've shown you, you can do in an IRA, even a very restricted account.
That's right.
31% say, whoa, didn't know you could do that. Got any more? Well, I've shown 2 income methods, and we have 11. And I haven't even shown the two sexiest ones. Good. Okay, Mike. Let me conclude this, and then yes, I'll give you the screen. Here's what our situation had been before. We had the far right edge, right? On March 26th, we didn't know what the future held. We bought in here. We didn't know what the future held. Okay. And we did an income method to help us pay for an insurance policy, and guess what? The stock continued going up. During the time that it went up, guess what? It touched $40.58, and it touched $40.58 again here. If we had simply bought the stock, right? If we had simply bought the stock and sold the stock with perfect timing, we'd have made a profit, right?
Oh, yeah, with perfect timing.
Right. Well, guess what? We didn't have perfect timing. We didn't have perfect timing, but if we did have perfect timing, we would have made $1.63 profit, or 4.2% based on getting in at $38.95 and getting out at $40.68. Okay. All right. Now, that's stock only, calling the top. But here, here's what really happened. Okay. On May 18th, we close for $40.14. Why? Because we're selling the stock and the put.
That's right.
We had gotten in for, it was $38.95, but remember when we bought the put option and also did income method number 6, it generated a 40-cent credit, right?
That's right, Kurt.
So our cost basis is really $38.55 getting in, not $38.95. So the difference when we sold the stock and the put for $40.14, and at the same time, our entry was $38.55. Well, it's $1.59 profit, not $1.63, $1.59. But when you divide your $1.59 by your $38.55 entry basis, Mike, we got the same percent of profit. Isn't that something? Okay. So what it is we've caught this movement, even though we got out after the fact. Even though we waited until here's April 17th, we get out in May. And Mike, if we got out in May with the stock, we'd be looking at a loss, wouldn't we?
Absolutely.
Yeah, but in fact, we use one income method that catches on the way up, and we use another income method that catches profit on the way down, and ended up with catching the whole deal. Okay. All right. So, Mike, let's go ahead and turn it over to you and take a look at that example that you want to. And are you going to use the PowerOptions software?
Oh, yeah, of course I am. That's the only thing I use.
Yeah.
Sorry. All right, let's see here. There we go. All right, so what we're looking at, Jane asked, can you go through a live example? Well, Jane, we're showing a live example here. This is not a brand new trade, and we're not going to start from scratch here and then take a look at it. What I'm looking at is a position that we are currently in Fusion. It's a little bit different, and I'll talk about that, but we have shares of Johnson & Johnson with a cost basis of about $70.58. When we originally opened this position, Kurt, the math was really simple. We bought the stock at around $70 per share. We bought the January 2014, and this was done in December, so it was more than a year. It was 13 months out in time. We bought the 72.5 put for about $5 or so. So the investment was $75. We had a 72.5 put. Our risk was $250. We've already rolled up once using income method number 4 from the 72 to 75 put, and we've canceled our risk about 2.3%. So that's what we're looking at. We have a cost basis of $70.58, and a January 75 put we're holding that we paid 620 for. So there's our investment of 76.78, guaranteed 75 back, or 2.3%. Now that the stock has moved up, I may consider selling to close, as Kurt showed income method number 4, our 75 put, and rolling to the January 80 put.
See what happens when you do that.
Let's take a look here. So I'll go into January. Now it shows me the 75 puts added, but I'm going to click it again. So now I can sell to close that. Now, have I lost money, Kurt? Yeah, I paid $620 for it when I bought it, and I could sell it now for about $275. So we lost about $350. But the stock's
in order for you to lose that, you've also gained in the stock.
Right, the stock has moved up to 78 or so. Now, I still want to be insured, Kurt, because I don't know where the top is. Johnson & Johnson could pull back. So I'm going to go to the 80 put, which is at 530 with the natural ask. So I'm selling for about $275, buying for about $530. So we've got about $2.60 or so, $2.60 debit. And why am I doing that, Kurt?
Well, what you're going to do is you're going to swap time value for intrinsic value.
Mm-hmm.
And now you don't have any break-even. I mean, there's no break-even line here anymore. You've got a maximum risk that's a negative amount.
Mm-hmm.
The maximum risk is negative $68, negative 0.9%, and you still have an infinite maximum profit.
And we have protection out to January 2014, and this is a dividend-paying stock as well.
Oh, and so you're going to collect dividends as well.
That's right.
Mike, walk us through it again, those four lines up there. We've got the 100 shares, if you just highlight that or underline it or whatever, 100 shares at $70.58, okay? And then the first time we're dealing with the $75 put is we're buying it. And the second time we're dealing with that $75 put is we're selling it because the stock has gone up.
That's right. Mm-hmm.
And that looks like a loss. It looks like, well, we bought that put for $620, and now it's only worth $276. Well, yes and no. It looks like we've lost money, but the only way that we can lose money on the put in this case is that the stock has gone up.
Mm-hmm.
Okay?
Yes, we've lost $344 roughly on the stock. I think that's right. And I'm sorry, we lost. Yeah, we lost $344 on the put, but our stock's trading at $78.38.
Yeah, so it's like $8 higher.
Mm-hmm.
The stock is $8 higher. If I'm going to lose $344 and make $8, I'm okay with that trade.
That's
okay,
right.
And then finally, you moved your put. You sold the 75 so that you could buy an 80.
Mm-hmm.
Now you have a negative risk. Now I want to point something out. This doesn't mean that Mike has a gain of 0.9%.
Oh no! See, as soon as I do this, go ahead.
Yeah. I was going to say it just means that if you hold for another year or 9 months, however long it is till 2014, okay, if you hold for another 9 months or 10 months, I guess, really, if you hold for another 10 months and make no adjustments,
no further adjustments,
you close your eyes and don't look at your dividends, okay,
right?
Then you're guaranteed to have 0.9%.
Mm-hmm.
But you are definitely higher than that now at a liquidation. So
oh, yeah.
Definitely higher.
Even after I do this, even after I do this adjustment, I could turn around and sell the 80 put for $525 and sell to close my stock at $78.40 or so. All I'm risking when I open a position or make an adjustment is the bid-ask spread at that point. So I'm still close to this gain we're seeing. It's probably up in this range here if I liquidated right now. We're actually pretty higher than that before doing the adjustment on the position.
Within the context of this, Mike, could you do income method number 5, the ratio call spread, with zero risk?
I could on another stock. The reason why I say that, Kurt, is that Johnson & Johnson, one of the reasons why I like income method number 4 and why I was going to show why income method number 1 doesn't do the same thing, because it's not the same price, is that it is more of a blue chip dividend paying stock, so the premiums there, it's very difficult to find a credit with an income method number 5 and very difficult to get a great credit for an income method number 6. It can be done, but it's just something I haven't been able, just like with Kraft, when you and I talked about that earlier, one of my first protected married put trades that I had Bulletproof for about 2 years and just kept collecting dividends and making other adjustments. But I couldn't really ever find a good income method number 5 on that stock because it just didn't promote, the premiums there just did promote that income method as well.
All right. Mike, I'm going to poll the audience here, and can you choose one of our audience's stock picks? You know, there's at least a dozen folks that texted in saying, "Hey, I've got stock that's up from where I bought it." Okay, but could you choose one of those guys and let's look at that?
Sure.
In the meantime, I'll put up this poll here, guys. What 2 takeaways did you get from today's lesson? Was it limiting risk down to single digits was something way better than a stop order? You know, that's what we did with RCI. We showed how to keep our risk, even if we were buying the stock, keep the risk down to like 4.5%, okay, and still have unlimited upside potential. Was it seeing how the put could be moved to guarantee a payout? That's what Mike was just showing you. How when your stock behaves a certain way, you can do a riskless adjustment that takes you into bulletproof status. Okay. Was it seeing how a spread could take income and still leave the top off? That's what we did with income method number 6. We took income, but still, if the stock continued to advance, you know, it wouldn't put a cap on the upside like a covered call would. Did you happen to notice the structure of a trade is more important than the trade itself? You know, more important than deciding what stock to pick or deciding what kind of technical analysis to use to get in and get out. More importantly, it's structuring the risk-reward payout. Or finally, did you appreciate bulletproofing? Did you appreciate taking a stock that's moved, and now that it's moved, you can make an adjustment and now have no risk, but still have unlimited upside potential? You know, not everybody is fortunate enough to pick Microsoft in the 80s. Not everybody is fortunate enough to pick Apple in the last 2 years, okay? But some of us did. And wouldn't it have been easier to hold on to it if we had a put option in place guaranteeing our payout at a certain level and using one or more of the other 10 income methods to 11 income methods to pay for the put option? Wouldn't that be something? Okay, let me go ahead and close that poll. And Mike, are you set up?
Sort of.
Almost. Okay, let me go ahead and share the results with everyone. It looks like the most popular thing there is that the structure of a trade is more important than the trade itself. And you know what? I would say that that's the biggest lesson you should take from today's lesson. That's the biggest takeaway that you should have. And the second place was limiting risk down to single digits was something way better than a stop-loss order. Yeah, a stop-loss order can cost you in terms of slippage. It can cost you in terms of getting stopped out of a stock when it just dips a little and then goes back up. And it goes back up without you. A stop-loss order is really, it's just a market order, which becomes active when the market maker feels that your stock is close enough. So, not a happy thing. Okay, let me go ahead and hide that. And are we set up now?
Yes. Well, I'm on the Married Put tab. And we're looking at the basic Married Put tab. If I wanted to open a new position, I'd go into the search tool. What we're going to do is use this nifty little tool called the Insurance tool. And one of our examples that came in was John had mentioned that he has CAT, looks like Caterpillar, at 54. So,
$54 cost basis?
Yeah, roughly a $54 cost basis. So put in CAT, and I'll put in 54. And what our stock insurance tool will do, I'm going to ignore this sell call month. I'm just going to look at the buy put months. And I don't know the expiration series for Caterpillar, so I'm going to leave it at all months. Okay, so let's go ahead and hit calculate. And there we go. Now what we're seeing here, there are some examples for April as Caterpillar, is up at $89. So there's a gain of about $35 on this position, it looks like, from that cost basis of 54. Wow. So 66% unrealized gain. Well, the stock could pull back for at the market top. Well, you could use a near-term option. Now, this is interesting. Someone asked, we could use the 90 put in April, which would only cost us $249. Now, this makes the new cost basis $56.49, so you have a locked-in profit of 59.3%. But, Kurt, what's part of the issue with that?
Well, there's not a lot of time for the price to develop, and there's also the certainty that the time value portion of that put is going to go to zero in a very short interval.
Let's say the stock and the volatility stays the same. Okay, all right, and in April,
$249.
Yeah, in April we have the 90 put. We lose the 249. Well, it might cost us 249 to buy the May 90 put if we want to stay in. Whereas right now, you could just get into the May 90 put for 370. Now you've got that 70 days in there, and you're not paying $5. You're only paying 370. And as we go further out, if we were still focusing on the 90 put, it's only $6 to go to 158 days out in time. So that's 5 times the 250, which would really put us at about $12, wouldn't it, Kurt, if I rolled month by month by month by month and so forth?
Right.
So that's one of the advantages why we're going 5 months at a time. Now, here's how I use this tool, Kurt, when I'm on a conversation or a coaching session. Since I don't know the expiration cycle of every optionable stock, I use the insurance tool. We type in CAT first. I put in our cost basis, and I used all months to begin with. And as Kurt mentioned earlier, where my eyes go, because I know how this time value works in our favor, that the option that's 6 months out in time is not going to be 6 times the cost. If I'm still anticipating further growth, but I want to protect against a drawback, or if I want to insure it, yeah, I could liquidate right now for a 66% gain, but if there's more to the upside, my eyes immediately, Kurt, go to this first series that's at least 150 days out in time, and hey, I'll also look at this series that's 312. Am I locking in as much guaranteed profit? No, but I've given myself another 5 months here, or in this case about, 10 months, almost 11 months for January, to continue to make other adjustments and realize upside gain. And I'm not paying 10 times the cost or 11 times the cost. I still get a lower cost per day by using the forward option.
That third column there, the third blue column, is the put time value per month.
Yes.
Right?
Oh, that's exactly right. Yeah, I should have highlighted that.
Yeah. So let's go down and select for who is this for, John?
That's John. Yeah. See, there's the April 90, which is $1.73.
Let's not do the April.
I'm comparing them, Kurt.
Oh, I see.
Then the May 90 would only be $1.52 per month, and then Kurt, your August 90 is only $1.07 per month.
Yeah. Let's go with the August.
Well, let's clean it up. Now that I know that I want to focus on August.
92.50. Can we do that?
Let me just go to August. Let's clean this up.
97.50?
Hold on a second, Kurt.
Oh, sure.
I just wanted to clean it up a bit. So we're just going to shift to August now that we've seen it's 158 days out in time. There's your 95, there's your 92.5, and there's your 97.5.
Okay. If you look at the 97.5, what is the time value per month that we're spending?
54
time value.
cents.
Okay. Now, I haven't looked at Caterpillar, so I don't know if this is going to cooperate or not. But can we go to the custom spread tool and can we put in?
Well, why do that? I can just go to profit and loss chart right from here because the system knows what numbers we're using.
Yeah,
I don't have to go click off to another tool and re-put in all those numbers, Kurt. That wouldn't make any sense.
Yeah, you're so cool. Okay. So now for John could purchase the August 97.50 put at 10.65. Now that looks like, you're throwing money away because, geez, $10.65. That's what I'm spending. But consider this, John. The stock isn't quite to 90 right now. It isn't quite to 90, and you're getting a 97.50 put. So it's worth at least $7.50, right? It's like putting $7.50 on deposit. So the other $3 is really all you're spending. You're not spending $10.65. You're depositing $7 and spending $3.65.
$3.15. Well, yeah.
I can't really see the numbers there. Is it $3.65?
I'm sorry. Yeah, it's $10.65.
$3.15. Yeah.
Yeah, $3.15.
Okay.
You got it.
All right. So let's go ahead and scroll up there, Mike.
All right, Kurt.
And folks, this is fascinating, and John, I hope that you appreciate this. I think that you will. Okay, let's look at the April calls.
Mm-hmm.
Now, we determined already that what we're getting for that what we're spending per month on this put option is 54 cents a month, right?
That's right, Kurt. Mm-hmm.
Okay, let's finance it. You know what we'll do is we'll sell the $92.50 call and buy the $95 call, and that's going to generate more than our monthly cost.
And I have to say something on this as well in a moment.
Okay.
No, you're fine, Kurt. I want to make something clear to everyone who's online. Okay, so there's selling.
So the credit there is in red, isn't it? The credit is $1.01.
That's what we're getting for the $92.50. Yeah.
Yeah. Do we still have an infinite upside potential?
Yes. If the stock continues to grow, what would continue on in this chart is that this line, as we saw before earlier on that other one, would just continue to move up, but more in a straight line and not the squiggly line.
Right. So we're spending 50 cents a month for insurance, but we're taking in $1 a month on the bear call spread.
No. Sorry, Kurt, didn't mean to mislead you there. The dollar is just what we're getting for the $92.50. Then we're paying 45, so we're getting about 56 cents net credit.
56.
It's not shown as the individual for that trade. It's lumped in.
My fault.
But you're right, Kurt. There's the payment for that first month of insurance that leaves the upside open.
Yeah, so we've got the upside open. If Caterpillar crashes, we sell it at $97.50, baby.
Mm-hmm.
If Caterpillar crashes from here, if $89.79 is as high as it goes, okay, and it crashes, we sell it for $97.50.
Right.
On the other hand, if it decides to continue going up, there's nothing that says it can't continue to go up. And if we're called upon to deliver our stock at, what is it, $92.50 for the short call?
That's right.
If we're called upon to deliver it at $92.50, we delivered it at a profit, but we also have a $95 call that we've been paid to own.
Mm-hmm.
We've been paid to own it because, after all, it's part of that bear call spread. We've been paid to own it. And so this is bulletproof, okay? John, congratulations. You're bulletproof.
This is not a recommendation or suggestion, but let me go back to square one. Jane, let's Jane put in another comment. Let's take it from scratch. We know the stock's trading at $89.79. Okay? We use the insurance tool to identify this position. Now, as you mentioned, Jane said, well, why not just sell the stock and take the profit? You could, but if you're expecting it to move up, why would you want to sell now? But we don't know the future. So the issue is, what can I do if I don't want to sell because I'm expecting upside, but I don't want to give this back, especially if there's a gap and a stop loss still could get me filled at a less price? Well, here's what we did. We had stock at 54. With the stock at $89.79, a 5-month output at $97.50 costs $10.65. But a little bit more than $7.50 of that is intrinsic value. We're really only paying $3.15 of time value for 5 months.
Right.
So once we enter that, we're guaranteed a profit. Now, even if the stock collapses, we've locked in 50.8%. That's a guarantee. The stock could gap down 30% tomorrow or 25% at the next earnings. We're guaranteed to make 50% because we've locked in that gain. Yeah, we paid a little bit to do it. We've locked in that gain. Well, if I've got a 5-month output and I'm risking $3.15, I've paid $3.15 into the time premium. That's my only true risk here. Well, that's going to average out to about 54 cents per month. So we want to pay for our insurance. Well, the first thought, the general thought is, hey, why don't I just go ahead and sell maybe a 92.5 call and collect $1? Well,
Mike, I apologize. I was hovering over the poll thing, and I accidentally launched this poll, so nobody can see what you just started showing. I mean, where you were just now.
Okay.
I'm sorry.
Yeah, it happens.
Hey, guys, you know what? Since it's up, you may as well participate. What would you expect to pay for a seminar or an information product that takes you through 10 of these kinds of adjustments. And Jane had written in, gosh, you need more than an hour, or an hour and a half. You need more than this. You should probably do a paid presentation. And guess what, Jane? We have. And we've got them all recorded. So what would you expect to pay for a seminar or information product that takes you through 10 of these types of adjustments? And of course, one is I wouldn't pay a flippin' cent. All you guys are crooks. And if you answered that, I would understand it, because Mike, I felt like I had been really hurt back in '99 when I had gone to that weekend cover call trading seminar and ended up losing my life savings. Okay.
Yeah. And I talked to customers over the 10 years. I've talked to customers who have lost, unfortunately much more than you and paid much more. I've heard of sessions that go on at another website where you start off with, $3,000 for a 2-week online session, and then the next one up is $6,000, and the next one up is $12,000, and the next one up is $20,000. So by the time you're done, you've almost paid $50,000 over a 2-year period, and these people are still calling me to tell me that they're losing money.
Yeah, and this isn't a product that you've sold them.
It's heavens no.
Yeah,
I just have to answer. Answer for it.
Look at this, Mike. Everything there's a multiple of 11 here. We got 11% being real honest, saying I'm not going to pay anything. You guys are all crooks. I'm not sure why you're still here, but 33%. Our highest response said, "Hey, $500 or more, but I consider it. I consider it if there is a guarantee." Okay. 22% said at least $1,000 is what I expect, but it better be worth it. 22% say I've spent over $3,000 for a less complete solution, and Mike, 11% are in that category that you were just describing. They've spent over $3,000 for, spent $6,000 or more for a less complete solution than what we have here. Mike, I took the screen. I hope you don't mind.
No, that's okay. I was it shifted as I was typing an answer to Sean, and then when you clicked on that, it threw me off too. So I was actually typing in a different place altogether. So it threw me off a bit.
Got it. Okay, folks, I'm going to wind up our webinar with an offer. Hopefully, I've delivered to you the 3 promises that I made at the beginning. The solution to a big problem with buy and holders. An income method that takes a credit but has no risk, and a method to ratchet up your profits as your stock continues to grow without risk. And that's the promise that I made. Hopefully I've delivered. Mike, when I talk about income methods, most folks go to the obvious, which is covered calls. Okay? But the problem with selling a covered call is that it limits the upside, right? So thankfully, I discovered a slew of ways to take income without selling covered calls, because after all, limiting your gains, okay, while leaving yourself open to devastating losses seems kind of backwards, doesn't it? And spread trades by themselves, a spread trade is good because, it can take a credit and put money into your account. And it also limits how much you could possibly lose if you happen to be wrong. But why not do a spread trade in such a context to where it can't bite you in the butt? I mean, wouldn't that be a better way to go? And so I got this crazy idea, more than 10 years ago, and I began blogging more than 10 years ago about this, that instead of cutting your upside, maybe limiting the downside would be a better way to go, and leaving the upside open to potential gains. And so far we haven't been proven wrong. It's been a wonderful.
And Rodney asks, if these techniques are so great, why do you spend your time and deal with complications of teaching them? Why not just trade? Well, Rodney, for myself, this is my job. I'm an employee of PowerOptions and Ernie's a Renter. I host the webinars. Why don't you ever see Ernie on a webinar? Because that's what Ernie does during the day. He created PowerOptions to trade his personal account, and he helps customers when they call in. He shows the tools. He discusses his techniques, and this doesn't sound sexy. I'll admit that freely. If I open a married put, I'm buying stock and I'm paying an extra 5 or 6% or maybe higher to cover the position, so I have a maximum 5 to 6%. You say, oh, well, you're not going to make money till the stock goes up. I've been trading for 10 years. I traded cover calls for about 18 months. Thankfully, I didn't have the experience that Kurt had, but Kurt's experience is not too far out of whack. I hear that often with cover calls positions. And over time, it's a sorting machine. I traded it for 18 months, never got ahead. And I was even right more often than wrong. I was right about 70 to 75% of the time. But sometimes you hit those months where you lose on the position, the stock goes against you, maybe I lose 20%. But if I'm only making 3% when I'm right, and I have one trade that gaps down 20%, and I have a 20 or 17% loss on my covered call, that just wiped out 5 or 6 previous trades. I'm now back to square one. Okay, so do spread trades so you're not risking as much. Yeah, now I'm looking to make 50 cents to risk 450 on a position that would have an 80% probability. I need to be right 85% of the time in order to be right. Why not just buy long calls and long puts? Because every investor I've ever talked to that has done long calls and long puts eventually fell into the trap of gambler's ruin and leverage trading. I've been trading the RadioActive techniques for 5 years now, almost 5 years, and this technique has been more consistently profitable for me over time because I don't fall into that trap. I don't get into a situation where, hey, it looks really attractive on a spread trade to make 15 or 20%, but then realizing, wait, I'm risking 5 times or 10 times that amount if it goes against me. And 1 will go against you. 2 will go against you. It's going to happen. The market is rampant chaos. So in a sense, that's what we're doing here. This is my job. I host webinars. I educate on the different strategies. I tell people what I do in my personal account. The reason why you'll never hear Ernie on a webinar, but if you call PowerOptions, you may get him on the phone, is because that's what he does. He's trading, and he uses this technique in a large part of his portfolio.
Mike, we had, Jane, thank you. Jane says, well-presented material. I wish you guys host a day-long seminar to look at live trades, not stuff in the past.
We did show a live trade, in a sense. Yeah. We showed two live trades. Yeah.
Sean says, what do you mean you lose money on cover calls? Looks like Sean hasn't been trading for a while yet.
Oh, I answered him. I typed into him, yeah. Mm-hmm. Talked about the 70-30 percentage, and that over time, just about every investor will find out that covered calls, using that as your one-trick pony in a portfolio, over time will work out as a sorting machine in your account.
Right. Sean also mentioned, I really like your techniques and software. I think it's very well thought out. Thank you, Sean. Mm-hmm. We've been tweaking it for more than a decade. What I'd like to do, folks, is present to you the blueprint. Okay. Now here with stock and a put option. Okay, we were able to put a floor on.
Kurt,
how much we could possibly lose.
Hold on. Are you trying to show your screen? Because you still have the poll up there.
Was.
There you go. Try that again.
Oh, I still have the poll up. Oh, for crying out loud.
There you go. Okay. That's perfect.
Is that better now?
Yes, sir.
Okay, good. All right. So when you buy the put option, okay, you cut down how much you possibly could lose, but then you've got to overcome the cost basis of the time value portion of the put. Okay. But using the income methods, you can reduce that. You can cut it down. And in fact, it's possible to use the income methods to completely pay for your put so that that gap is reduced to less than 0. And in that case, we're bulletproof. And Mike, you happen to be bulletproof in at least one position right now, don't you?
Yeah, pretty much.
Or are you anymore?
No, I had one position in bulletproof status, and I took it out to roll the call. Adjust the income method number 1 position. I had to pay more because, as you know, Kurt, every time I use income method number 1, I'm going to have one of those stocks that gains 30% or so. That's just the nature of the beast.
Silly boy, should be using 6.
Right, so I took that out of bulletproof status. Ernie currently has 3. I have one other one that's bulletproof, and I'm going to have another one today, most likely with Johnson & Johnson.
Right. So bulletproofing is the situation where you can't lose, but you can still continue to tick up. You can still continue to tick up on a stock. And that's the situation that we have when you pick up the blueprint. Okay? I'm going to go ahead and get into radioactive trading here. Okay? And show where to pick this up. Jane had been writing in saying, would you please show me where to get this? And capitalize, please. Thanks. There, Jane. At RadioActiveTraining.com, if you go to the products page, okay, we've got the blueprint, okay, the blueprint at $339. Now, what's really great about this is that, Mike, if I were investing in this education, okay, if I was to pick up the blueprint for $339, and it turned out to not be everything I wanted it to be, the most I could possibly lose if I paper traded, like we suggest, okay, the most I could possibly lose is the $339, right?
That's right.
Right. But if it was covered by a guarantee, then how much could I lose?
Well, nothing.
Okay. And I would still have the potential for gain if indeed it was what I was looking for, right? Okay, so folks, we talk about bulletproofing all the time, getting yourself into a position where you can sit on a stock and allow it to continue up, but you can't get hurt, okay? Since we talk about that with the market, we're going to do that with our product, okay? And that's how I've been offering it for the last 10 years, is that you pick up the blueprint. We have very few returns, but when folks do return it, it's very swiftly and cheerfully refunded, okay? If somebody says, man, I don't know, it's just not for me, we say, fine, we do take suggestions on how to improve it, but and that's why it's at the pinnacle that it is now, okay, with all 11 income methods. The home study kit is a little bit more, and then Jane, this is for you, okay? These are recorded versions of actually different trades than what's in the book, okay? But all 11 income methods are discussed in the CDs, and then it's a multimedia type presentation. So if you learn better by way of multimedia, this is a better value. Okay? If you feel like, geez, all I want is the book, then this is a better choice for you. Okay? And they're both guaranteed completely, which means that you have zero risk. So kind of a cool deal. Okay, Mike, I think we should probably cut it off there. I had more I could share, but it looks like we're at the end.
Let me check something real quick. I'm sending everyone a link, Kurt. You go RadioActiveTrading.com to pick up the blueprint, but if you also want to test out PowerOptions, free trial for 14 days, just requires first name, last name, and email address. Just go to powerop.com/RAT, and I just send that to everyone, and that should give you access to the PowerOptions tools, those that I use today to show the insurance tool, and then on the fly with the custom spread tool there, but you can get that for 14 days as well.
Very good, yeah. And PowerOptions is just a fabulous program. They I was a customer of yours before we teamed up. I was a customer of PowerOptions for and the thing is, it just saves so much time. Saves so much time and makes things so much more clear. It's easier to make decisions trading with that. Okay, Mike, I'm going to make it available to the others whose stock symbols we did not use, because a lot of folks wrote in saying that they had stocks that were up from where they started and want to know what to do now. Folks, I can't give you advice, quote-unquote advice, okay? I'm not a broker. But if you'd like to send your trade to me at Kurt, K-U-R-T, at RadioActiveTrading.com, okay, or support at RadioActiveTrading.com, then I'd be very pleased to look at it, give you a second set of eyes, and show you what you may be able to do to even pay for your blueprint. That's... I'm sending it to you right now here. Kurt at RadioActiveTrading.com. If you'd like to send me your stock symbol and your cost basis, you don't have to tell me about your whole portfolio or anything like that, but if you send me your stock symbol and your cost basis, I'd be pleased to look at it and show you how you might be able to bulletproof your stock, and I do that for free. Okay? All right. Mike, it's time to wind her up.
Okay, sounds good.
I'll see you on Thursday.
Yes, you will.
Very cool. Looking forward to it. Folks, thanks for coming out today, and thanks for all the kind words. A lot of folks wrote in with some kind words, Sean and Jane and William. So we'll see you out there. Happy trading. And Mike, I'm looking forward to our next meeting.
All right. Take care, everyone.